All right, so welcome everybody. Welcome to today's webinar. I know this is summertime, also right after July 15th tax date, so we probably prefer a moment on the beach with this hot weather, maybe at least thinking about going to the beach. Anyway, we have a pretty full agenda, so I have to say, of all the topics that I presented, retirement income planning is probably one of the most complex. There's so many variables, and it's definitely not just one set of rules to follow, and so many what ifs too. So at the end of the session, I have a Calendly link. So I'm offering a free consultation session. So if you want to take advantage of it, please click and help me clarify. Let me help you clarify on the topics that you still need assistance on. All right. So that's my promise to you. So let's start by looking at today's agenda. What we're going to do is we're going to cover retirement income cash flow. So we had another one like 2-3 weeks ago to talk about retirement income planning, but today we're going to focus more on the cash flow. So if you think of the other one is like a introductory class, this is definitely an intermediate to an advanced class. So a lot more in depth. Where are the income sources coming? How much do you need? And I want to spend a little bit of time mapping the expenses to different income sources. But what I really want to do is to make it simple. The simpler it is, the better it is. There's just too much complexity involved. And I want to talk a little bit about long-term care because 50% of the retirement income plan fail because of medical expenses. So I want to focus a little bit on long-term care. How do we finance the end part of our life, which is super important, and where's money coming from? And cash flows. I'm getting this questions like almost every single day. How do I convert investment to cash flow so I can live off what I have made, what I've saved? So we're going to look at different types of products. It's very interesting because some of them are providing pretty nice return. So let's just start. Okay. So as we move towards retirement, there are a lot of decision points. Housing. Okay. So do we still need this nice grand house? How are we going to withdraw Social Security? Social Security withdrawal strategies. Sorry. And then like, how do we distribute from our financial assets? And we need to ask the right questions. Okay, so longevity, how much would you plan on your longevity? So how many more years are you gonna live? Okay, so should I pay off the debt of my mortgage when I retire? Should I not? Downsizing, this is a huge question. Should I downsize, relocate to a cheaper state? State with no income tax? Yeah. Assisted care as you age. So maybe move somewhere, that can provide some more additional. I want to travel. I work so freaking hard. This is my reward time. I want to like do what I want. I want to travel around the world. So how expensive is that going to be? And there are also people who want to live close to my grandchildren. It's so cute to see the little babies, saying hello and learning, about life. It's really, really very fun. So they want to know, how they get involved with the kids' lives and the grandchildren's life, just to remember you. And we talked about it already, long-term care, taxes and distribution. We're going to play down this because this can get a little complex. I think there are other bigger topics that we want to focus on today. And jobs, a lot of people, retirement is not the end of my working. I still want to work, so maybe not work so hard. Maybe I just want to pick up some part-time income, continue to meet friends, and maybe learn something. So here, these are real statistics. Okay, so average retirement age for men, 64. Average retirement age for women, 62. So how long can they live? All right, so if you're lucky enough to hit 65, you are supposed to live, average statistics, the average is that you live to at least 83. And for women, 85.6, so close to 86, which means that that's good another 20 years, right? 20 years that you'll be spending in retirement. And if you got good genes and if you're smart, I heard that if you're the more educated people, they actually live even longer. So you're gonna hit 90s. And then the other thing is like 33% of the retirees says goodbye to the job. Only 30% say goodbye to the job as when they have planned. So a lot of people are getting into unvolunteered retirement. So they probably said that I'm gonna work till like 70 or 75, I'm not gonna retire. But the real story is that whether they like it or not, maybe of health reasons, maybe of job reasons, they're gonna be retiring earlier than they think. So you need to prepare early, so as early as you can. Um, so how many years of longevity should you plan? Like just we talked about the numbers that we just looked at, 83 for male, 86 for female, that's the average, so 50%. However, if you're lucky enough, 25% of us would be hitting our 90s. So when you plan, don't just plan till like 80 something. You should plan for like at least like up till 90 because you might be lucky. I mean, so I would say like if you retire 65, don't just plan up till like 85, plan till like 90, add a couple more years. It's always good to know that you have some additional cash flow. And here, let's take a look at these, some risks of retirement. I'm pretty sure a lot of people talked about it over and over and over again. Reduced earning capacity. Okay, so you stop working, so the income is not quite the same. And then limited investment options because you're worried about risk, so you can't go crazy about like investing whatever you want to invest in. Sequence of return, like if you have like a bad year, particularly when you just starting your retirement, it's hard to recover. So like, you know, it's like if your investment dropped by 50%, it takes 100% to get back to where you were. So, I mean, just because of that, you need to be a bit more careful about downside. Unknown longevity, we talked about that already. Spending shocks, long-term care, health, divorce, changing house needs. And because it's 20, 30 years, so we're looking at like compounding inflation, you know, the compounding factor from the inflation. So even 2, 3, 4% over 20 years, it's a lot of money. And then this other sad thing is like declining cognitive ability. Doesn't matter how smart you are, we know that as we get older and older, our mind is not quite the same anymore. So we need to plan about that for that too. This is an interesting chart. Sources of retirement income. Okay, so this is taken from US Census Bureau, okay? So when you retire, where's the money coming from? 30% of the money is coming from Social Security and another 31% from part-time income here. See, you know, a lot of people continue to be working part-time. And then 18% from pension for 401k investments and personal investment savings, another 10%. So here, these are the money that you put aside, you know, from your 401k, your personal investment spending. And then here you continue to work to bring in 1/3 of your retirement income. And then on top of that, Social Security. And how much do you need? Well, people must be telling you, oh, you need at least 80, 85% or be 90% of your pre-retirement income. It depends on how much you make, of course, okay? The less you make, you know, as a percentage of the pre-retirement income ratio, it's gonna be higher. So less than 50,000, you know, we're probably gonna need almost all of it. Let's say 80%, and between 50 and 80,000, so 75% of your pre-retirement income. And if you make more, maybe less. But I'm seeing some super rich people make a lot of money, over $200,000. They can spend it all because they haven't traveled. So hey, look, you know, I don't do all those things I've never had a chance to do. This is from Fidelity Financial Solutions 219. And then here, number of households at risk of facing a shortfall ranges from 42 to 60%. So we're talking about half of the people, American population, is at a risk of retirement income risk shortfall, okay? So we need to really think about how to plan it. Lots and lots of people are asking about Social Security withdrawal strategies, maximizing Social Security. What is like, when should I take my money out so I'm not gonna lose out on Social Security? A lot of it depends on how much money you need, when you need it, do you really need it, and so forth. If I can wait, of course, you know, I'm going to get more. So here are the rules, okay? The more you make, the more you get, but it's not one-on-one. Okay, you see, like age 62, if you make $50,000, you make your payout is $1,000 a month. But with double that, it's not double here, okay? Okay, and it's quadruple. This is only double. So it is not that the more money I make, the more money I get. Okay, it depends on. It's actually discriminating against the people who make a little bit more money. And then the other rule is like later you can, the more you can wait, okay, the more you get. And I'm assuming date of birth is January the 1st, 1960. And for those people who were born on January the 1st, 1960 and after, your full retirement age is 67. that's the year if you take Social Security, you're not going to get any penalty on your income withdrawals, okay? So if you take it at 62, there is a 30% penalty, okay? Early withdrawal penalty. So you should be getting 1,005, but if you take it 5 years earlier, you're only getting 1,000. And if you wait, then you're going to get more. So if your full retirement age is 67, if you wait another 3 years, you get another 24%, 8% per year, 3 years, 24. So look at 62 and 70. Wow, you see, it's like double, right? So if you have the free cash, it might be worthwhile just to wait, okay? Wait it out so you get a lot more income. The reason is, like, you know, Social Security, whatever it is, it's also inflation adjusted. There's a, you know, a couple and 1, 2, whatever percent. So they do adjust it upwards. And then even if you have no income, no sources of income, you know that the government continues to pay you. So this is something that you can rely on. So if this is how much you're making, okay, so I multiply by 12. Okay, so when you multiply by 12, this is the yearly income you get from Social Security. Okay, so if you're making $200,000, it's not a lot. Okay, so if you're used to spending like 80%, so $160,000, you're only going to get, even if you wait out to 70, it's only 47. So there's a big part where the other money is going to come from. Okay, and if you want to figure out, you know, more precisely how much you're going to get, you know, tap on this calculator, click on this link, and then put in your information, how much you make, when you want to retire, and so forth, and take a look and see what kind of income you're going to get. Certainly, definitely recommend trying it so you know how much you're going to get from the government. Now, okay, here's the assumption. Okay, I just thought that might be interesting to just look at husband and wife. Okay, husband is a primary bread earner, and wife, let's say, doesn't work or like not bring as much income. So when I estimate the Social Security income, I'm assuming maybe I'll get 1.5. So 150% of the targeted income. Okay. So even if the wife doesn't work, normally, you know, because just being the wife and being married to somebody for 10 years or more, you get 50% of what your husband or the other person, the primary bread earner, gets from Social Security. So this is what I assume. Okay, so you look at the other chart. So let's say $12,000, okay, for one person. So 1.5, husband and wife, 50% the wife, 100% for the husband. So this is what you expect to get, $19,000. So it's $19,000. Okay, so 1.5 of the scheduled payout. So that's your part of your family income. Stay married and you two live together, okay, and then you can share the expenses and so forth. And then I plot it out, okay, if you withdraw at 67, that's how much you're gonna get, 70, this is how much you're gonna get. And if you look at it, what's the percentage of the 50,000, okay, the income would be, if you take it out at 67, age 67, that's 56%. Now, if you look at this, it's still not a lot of money, 28,000. Can you really live on $28,000? New York, nah, I mean, I don't know, I mean, like, it's gonna be really tight, okay? So if you can afford to wait a little bit, so then you get a much higher number. But what we're seeing is that, okay, let's go back to here, I forgot to mention that most people withdraw before 67 or their full retirement age. The average Social Security payout is 18,000, okay? So 18,000, and the average wage is like 52. So it's between here and here, right? Okay. And then, but the number is 18,000. It's not even 18,792. So you know that people are taking it before their full retirement age. So it's around here. So that's, you know, 65, 66, I don't know, whatever it is. So, and we talked about that people are forced to retire before they plan, their planned age. So, and a lot of people think that, oh, well, you know, I retired, if I can take Social Security, why not? So they start taking it out. So, and if you take it out before your Social Security, your full retirement age, there's a penalty. And look at this chart, 54.7% continue to work part-time between 60 and 64, and even 65 to 69, 31%. So quite a huge population, quite a big populations continue to try to bring in income to help subsidize their retirement. And these are the typical jobs: tutor, instructor, tour guide. I think that must be fun. Tour guide, right? Photographer, handyman. Some of the guys are really good at it, so they can maybe bring in a few bucks here and there, you know, helping people do some paint jobs, minor paint jobs, whatever, decoration. Uber driver, host Airbnb, and online retailer. So here's just some ideas if you want to continue to work and you want something, you know, to bring additional income. Here are some options. Okay, this is what, okay, everybody does it differently. Okay, this is what I thought would be the easy way, an easy way. And I just want to share it because retirement income planning is so complex. So I'm trying to make it simple. First thing is that we talk about Social Security, right? So I want to map Social Security income to my essential expenses. So what are my essential expenses? Housing, medical expenses, and food and transportation. And before I retire, I should try to minimize my debt. The reason why? Because my income is, you know, I don't have any additional income or like whatever new income stream is not going to be comparable to what we have currently. So I don't want to have like sustained outflow of money. So I want to minimize my debt. If I have additional part-time income or whatever, I want to pay that down as much as possible. So I'm not at risk of running out of money. Same thing, like if your kids are old, you know, grown, I mean, you don't need to live in a very expensive school district. Maybe you don't need a huge house. I mean, caring for a huge house is not just like, it's money too, like more lighting, more utilities, more everything. So maybe, I mean, it's got, of course, it takes a little bit to get adjusted to, but downsizing to a more reasonable living area, cheaper, lower maintenance might not be a bad idea. Take some adjustment too, but what I'm hearing from people that moved out from their huge house to a condominium or like a 2-bedroom apartment, they said, oh, I don't regret it. And yes, I had to throw away a lot of things, but I got used to it. I certainly don't miss like doing all this extra work in my house. And when I see that big bill, like, you know, that tax bill or whatever mortgage bill, I'm so glad I'm not paying it anymore. So I suggest mapping your essential expenses to your Social Security pension money. Okay, so if we go back and let's say, okay, so if you're making only $50,000 and you're getting like $28,000, so you want your essential expenses not to exceed this. Okay, so minimizing the debt, downsizing, whatever, these expenses not to exceed $28,000. Okay, if you're making 50, all right. How about non-essential expenses? So, okay, travel, education, go out to eat, okay. So if you've saved up some money for retirement, there's something called a safe withdrawal rate, which is 4%. So just take the 4% of whatever you saved and use that for your non-essential expenses. So if that year the stock market does very well, instead of like, you know, 10% get 20%, whatever, then, you know, you have more money to spend, okay? And if the stock market doesn't do very well, losing money or breaking even, then sorry, you know, you'll get to travel, okay? You can afford to skip 1 year. So because you're more flexible with your expenses, you know, that will help avoid depleting your principal. So that's pretty important. And the last thing is like, okay, so we talk about part-time income. Most likely, I mean, if you're making only $50,000, you add all these expenses up, you're still not going to make ends meet. So you probably have to take a part-time income, okay? So that will help, you know, with the shortfall, additional saving, or emergency cash, which is also super important. Now, the next thing we're going to do is look at numbers. I know a lot of people are really good numbers, so it all makes sense that we start looking at numbers, okay? Same assumption, husband and wife, 1.5 times of the estimated Social Security income. So how are we going to make ends meet? All right, so this is actually, I pulled it up from like average retiree, pre-retiree income expenses. How are they allocating their expenses? As you see, the number one item, housing, 34%. And when I look at the $18,000, this is definitely not New York. We're paying a lot more than $18,000 for a tiny little place. So, but you get the point. So this, on the average, like people continue to spend a big chunk of their income on housing, even after retirement. Medical expenses, we're gonna go over that a little bit later. Food, transportation, and then entertainment, these are non-essential, okay? So that adds up to 53,000. Okay, any question? So this is like something that I pulled up from the internet, like how people are spending the money, if they like average national expense housing down to as much as possible. Like 34 may be high, so I would say, let's say 10, okay? And oh my God. So medical expenses, 12,000. You're gonna see it's about like $6,000 per year when you reach 65, about $500 per month. Food, I think that's pretty low. Transportation, so instead of like a nice like SUV, maybe I can downgrade it to a small sedan. I probably still need a car, all right? And then this is like 4%. We talk about safe withdrawal rate, 4%. And this is the average national savings of pre-retirees, $175,000 only. It's not a lot, so it's kind of sad. So that is like $7,000. So that's how I come up with, if I do all this, I come up with my spending to be just 40,500. Now this 33,500. If you look at the Social Security income, I mean, it's like 28 or something, right? So I'm not making ends meet unless I wait another year or something, a couple of years till 70. If I were to use my Social Security income to pay for this, 33, and this is 33. This is no, this one, 33, right? So you have to kind of wait a little bit. All right, let's get back here. All right, so and then these are the well, I still have to, you know, go out a little bit. So this is your budget for going out, and then if you add all this together, it's $40,000. I'll answer your question. Who has the chat? Who has a question? Maybe you should just talk. Oh yeah. Household expenses. Yeah. So John, this is inclusive of everything. That's why I said this is not realistic for New York, and it can only happen if you downsize, basically pay off all your mortgage.
Right. Well, what happens if the people?
Just even.
Right, but what happens to the people who still have a mortgage?
I know. So that's why retire. You have to work very, very hard on limiting your mortgage, or just downsize. So instead of your house like $500,000, you move to a $250,000 house, and then the mortgage, let's say, is $250,000. You pay it up because you move to a smaller house. Makes sense?
Right, I understand.
I'm not saying it's easy. It's a huge decision. You completely downsize. If you're gonna keep it, you're not gonna make it. Because like I think of like multiple times how I'm gonna cut this. There's like no way if I want to continue living in the same space, and I have a mortgage that I had to fulfill, I had to pay. And then because of the mortgage, I have utility, I had to pay the gardener, I had to pay everything. So you have to think small. I mean, you can continue paying for this. If you want that, fine. Okay, so let's say, you know, your Social Security budget cannot pay for all this, you're down like $10,000, then you have to make it up from picking up a part-time job here. Or hopefully you have more investment income and you can use this to pay off that. In this example, all I'm trying to do is that go as bare minimum as possible. For those people who don't have much saving, this is national average, who are not making a lot of money, $50,000, that's the only way, you know, I can think of making ends meet. So they're not like running out of money. For people who have more means, okay, if you have more investment income, if you have $1 million, obviously you can use your investment income to subsidize this, or you can continue to work more to subsidize this. All this is additional, be nice to have. So here, this is just an example of the lowest possible expense that we can use to get by with the Social Security income payment from the government. All right, thank you, John. Now let's take a look at the healthcare expenses. This is just like a rough calculation. I go online. So Part B is 144, Part D is about $50. It's all income adjusted though. So the more you make, the more you're gonna pay. And maybe you need supplementary insurance. So out of pocket, dental, vision. So annual is about $4,000 or $5,000 to $6,000, $7,000. And we estimate here 6,000 per person. So it's 12,000 together for husband and wife. This is like really lean. I mean, to make this happen, okay, like 2 people, all right? And then you can afford everything with the housing and everything, and you try to get Social Security to pay for all this. I just thought it's pretty amazing, but you really have to do your part, like downsize, cut your housing expenses. Medical expenses you can't cut because that's what it is. You know, probably go up, not go down. Food, transportation, minimal, you know, to make this work. Okay, so 50% of the retirement income shortfall is due to healthcare expenses and long-term care expenses. So we're going to talk a little bit more how to fund for the long-term care. Here's some sad statistics, okay? Men, almost 50%, 47% would need long-term care. Women, 58%, so more than half, all right? Average age of admission is over 80. So if you buy long-term care at 60, be prepared to pay for it for at least 20 years. Otherwise, it's good for nothing, okay? You lose all the premium that you pay. Average number of years for men to be in long-term care, 2.2. Women, 3.7. Now, here's very interesting, I thought. Average number of years for people who are married, lower, much, much lower. Maybe your wife is like helping you with long-term care, whatever, you know, you're happier. So average number of years for single, never married, 3.8. So it's kind of risky. I mean, if you're not married, living alone, the likelihood that you need more long-term care, number of years is much higher. And this is how you fund for long-term care. If you have very little money, don't worry, the government will pay Medicaid. If you have lots and lots of money, don't worry, I can pay for it myself. I don't need any of these fancy tools, okay? But the big middle, the people who are not all the way up over there that can finance long-term care, or, you know, I like right in the middle, as I don't have, it's not that I don't have anything, I have something. So what can you do? So we're gonna look at long-term care insurance, life insurance with long-term care rider, annuity with long-term care. Anybody has heard of annuity with long-term care? I thought it's pretty interesting. As a matter of fact, a lot of people are like the long-term care, less and less people buy less long-term care. A lot of people are switching over to annuity with long-term care. Anyway, we're gonna go over that a little later. And reverse mortgage to fund for long-term care. So these are some options. I don't think any of these options are perfect, okay? All depends on what you need. And in general, I would say, I'm not gonna just buy life insurance with long-term care. I will buy life insurance with long-term care only if I need the life insurance. And same thing, if I need annuity, I have annuity anyway, I'll add the long-term care rider. Anytime when you have like 2 benefits, it's gonna be a little bit more expensive. So I'm not gonna throw it in, I'm not gonna buy life insurance because I want long-term care. It shouldn't be that way, okay? So we should plan for 2 to 3 years. We look at this here, like, you know, you need 2, 3 or 4 for men. So you should plan for like 3 years, okay? And then if you are thinking of buying long-term care, do it early, because when you're 70, there's a 44% rejection rate, decline. So if you apply, you're not gonna even get it. Even if you wanna pay, sorry, we're not gonna insure you. Plan for a benefit for at least like $51,000 a year. This is national average for long-term care. New York, certainly much more expensive, like at least $70-something thousand a year, okay? So that's just the back of your mind, like, you know, even if you can't fund for 100%, try to fund for like 60-70% of it. Here's Medicare, okay? So if you belong to that other extreme, you just have to spend down your income or give away your assets. it's a really pretty low amount. I don't have the numbers here, but it's very, very low. And you had to do it 5 years before you actually need the Medicaid for long-term care, because there's a 5-year look back. And if you don't fulfill the 5-year look back, they're going to take some of your assets away, or you have to pay for some part of the long-term care itself. So this is complex. So I'm not going to spend too much of it time on it. It's worth another seminar just to talk about Medicaid. What I would say is that start planning early, and then hire an expert to help you with the Medicaid filing. Here's some of the statistics. Here, this is when I first saw it, I said, wow, okay, so you don't want to pay for long-term care, so you want to wait. Let's say I don't even mind paying higher premium, but look at this. 51%, half of the people not going to get it if you wait too long to get long-term care. Your application is just going to get declined. And the government also knows that we need long-term care, so they encourage you to purchase long-term care and try to provide some tax incentives. So here are some deductible limits for like different ages, like how much you can deduct on the premium that you pay for long-term care. It's pretty nice, also helps. Here I thought so it's good to see some numbers. All right, so the left-hand side, this is long-term care insurance premium, and the right-hand side is life insurance with long-term care rider. And age 60, male 2,000, female 3,000. Female, we always have to pay a little bit more. 2,004 for male if you're 65, and 4,006 for female. And when you hit 770, it's 3,000, close to 5,000. Now this is life insurance. This is almost double, okay? The male premium and the female premium is like a lot more. Because you're not just paying for long-term care insurance, you're also paying for the life insurance. So when you pass, like somebody's going to get that $300,000. If you don't need it, the long-term care, you bought it, so it's too bad. You know, there's nothing to, it's not like they can return the premium that you pay. But with the life insurance, you will still get the face amount back. So that's why it's so much more. And then if you need it, it also really pays. So I want to just like, this probably slightly on the low side because this is the premium for 2017, but you get the point. I think we have $2,000 or something. So it's about 10% more. So you have to keep paying, right? Okay, so you start at 50, 10 years, 20 years, 30 years, 40. Most people need long-term care when they're in the 80s. So you would have to pay this much. This is the total that you would, premiums that you have paid. 30 years, 20 years, this is how much you would have paid until the time you actually need it. And how much does it cost long-term care? Here are some expenses, right? I don't have to tell you that, okay? 1 year you'll get it back. So it's the thing is like, do you have the cash flow? Can you afford to keep it for 20, 30 years? And if you were to buy it, you know, you had to buy it early. Case. Otherwise, like we saw, like if you try to buy it when you're 70, they might not take your application. You might not even be able to get it. Okay, so let's look at home equity, reverse mortgage. We know that most of our net worth is tied to home equity. Over 50%, 55% of America's net worth is tied to home equity. And 90% of the people age 65 wants to stay in the current home for as long as possible. So you want to stay in your own house, and let's say if you run out of cash, you can't afford to pay, let's say, even income tax or something. So what are you gonna do, okay? So this is the last asset left. So the only way is to do the reverse mortgage. And reverse mortgage works for people who are 62 or older, and you have to have equity. I mean, like a lot of times if you have a lot of mortgage, it's not going to work. Okay, so here, this is how you can take money out. You can take money out by taking a lump sum. You can take it out only when you need it. So it works like a home equity line of credit. Or you can do monthly payments. Oh, lump sum cash payment at one time. So you pay me a lump sum cash. Some people sometimes use it to buy second house or something, a line of credit. And here are the borrowing criteria: age 62, max borrowing amount is $765,000, and you can only get 50 to 60% of home value, and it must be primary home. And you need to have independent credit counseling session with FHA, Federal Housing Authority, approved counselor. So they want to make sure you understand the economics, the numbers behind it, why you're doing it. This is something you need to know. Like, reverse mortgage must pay off any outstanding liens against your property before you can withdraw the additional funds. So what does that mean? Let's say you approve 500,000. So max is that you can only approve like 50, 60%. So you must be owning like $1 million house. The $1 million house, you still have a $250,000 mortgage. So you only get $250,000. It's the $500,000 you get from reverse before you can use off the funds. Because they're smart, okay? If you still have a huge mortgage, you know, I mean, like, where's the money paying me back? And if I have to take your house and sell it, I'm not gonna get a lot of cash back. So they're very smart about it. So what's the advantages of a reverse mortgage? No payment on loan as long as you stay in the house. And the money is withdrawn tax-free, and it doesn't affect your Social Security or Medicare benefits. Now, this is very important, okay? So it's not income adjusted, that it's a loan, right? So it's not income, so it shouldn't, and you just shouldn't have to pay taxes on it because it's a loan. And it doesn't affect your Social Security or Medicare benefits. No tax on the distribution. Like I said, it's a loan, so it's not an income, so you don't need to pay tax on it. Equity line of credit also grows at an assumed inflation rate. Now, this is something I just learned. It's pretty 500,000. They also assume there's an inflation increase on the house. So that $500,000 will increase by 3% every single year. So even if you don't use the credit, it will keep growing. And you can think of it this way, you know, this as like funding for your long-term care. The long-term care expenses certainly grow every single year, probably more than 3%. But you have something that also grow to keep up with the rate that long-term care expenses growing. And you don't have to withdraw it until you need it. So let's say you don't need it, then that's okay, fine, you know. Later on, when you pass away, I mean, the house will go back to your beneficiary. And the interest rate is usually a little bit lower than traditional mortgages. And then, you know, if you take out a mortgage, what happened? You need to pay back the bank. With the reverse mortgage, they pay you. You don't have to pay back what you borrow. So it's completely different. So you get cash. And any other way, when you borrow money, you always have to return. So that's why it's so attractive getting to do the reverse mortgage. The additional income enables aging homeowners to stay in their home longer and to maintain their independence and security. So that's the whole point. I don't have a lot of like assets anymore. I mean, the biggest lump sum that I have is my house. And I'd like to stay there, and most of the mortgages be paid off. I want to take the cash out, and I don't want to pay taxes on it, and I don't want it to affect my Social Security, and I might not need it, but if I do, I know it's there. So all these criteria, it's like very flexible, and it's also growing too, okay? Even the equity line can continue to grow. So that's probably a nice insurance if you compare. It's probably depending on how you look upon it. I mean, like all the other choices, long-term care, annuity with long-term care rider, all that, you know, you're paying for something. It's not exactly cheap. Doesn't mean that this is cheap, okay? Total expense is probably about 3% closing costs, you know, of the house. So it's not cheap, but you have a lot of flexibility. And if you want to stay in your current house, this might be a good option. This might be an option. And this is what you can use it for. Oh, by the way, you can use it for anything: living expenses, home repairs, medical bills, paying off existing debt, education, travel, long-term care, and long-term care insurance. And maybe use that to finance your long-term care insurance, estate plan, gifts and trusts, purchase life insurance, anything that you can think of. So it's cash that you can take out from your house to pay for whatever you want. Very flexible. Now, of course, like, let's take a look at the advantages disadvantages. Long-term care, the amounts, like how much you can deduct each year, depending on how old you are. The disadvantage is like it stops, and it's harder to qualify. Insurance long-term care rider, it's more expensive because you're not just paying for long-term care, you're paying for long-term care and life insurance. Annuity with long-term care rider, okay, you can purchase at like 150% or 200% of the annuity payout. So this is a little more complex to price, you know, which is why I don't want to give an example, because annuity, it grows, depends on what kind of annuity you purchase, and then depends on when you annuitize, and then they'll give you the rate. So it's a bit more complex. And then the main thing is that you need to remember, all this you pay as you go, or you pay, you know, a small amount. Annuity, you pay everything up front. And the annuity income is taxable, right? But interesting thing is like the annuity with long-term care rider is much easier to qualify compared to long-term care. So I hear this is like 80 to 90% qualification to be able to qualify. They still need to look at your, you need to do a medical exam, etc., but much easier to qualify. And reverse mortgage, why I like it is it's flexible, and the payments are not taxable, and the line of credit also keep growing. Now, but the downside is expensive. And then we talked about the funds must be used to pay down the mortgage debt first. So you have to zero out the liens, so they can, you know, use the house to pay back all the loans that you take out. And you must continue to maintain your house, and you must live in the home, in the house. It has to be your primary residence, and you have to live in it. All right, so that's long-term care. Any questions? If not, then we're going to switch to a completely different topic. We're going to talk about income distribution. Good? Okay, so, okay, here. So we're going to talk about, so we have investments. So how are we going to convert the investment into cash flow so we can live on this cash flow? We talk about the 4% rule. So let's say you have $100,000. You have 4% would be 4,000. So if you live on that 4,000, you withdraw that 4,000, likely, you know, it's likely that you'll be able to use it for like 25 years without depleting. I mean, you'll be able to use it for at least 25 years, okay? And then there's like something called time-based segmentation, the bucket approach. So you prioritize your money into like short-term, medium-term, and long-term, and then map it against like different type of investments. So short-term would be lower risk, medium risk, high risk, It's more work, okay? And then another way is called the flooring approach. Lower risk for things I need, essentials, okay? Higher risk for discretionary, things that I don't need, okay? Like traveling, vacation, you know, okay? So, so these are the three ways. The one that's most preferred and easiest to manage is actually the 4%. As you can see, you know, I'm more flexible. So 4% on a bigger amount is more because the market is doing well, then I get more to spend. And the other thing is like, every time when you do like short-term or low risk, whatever, you map the expenses. You're going to be mapping it against like cash accounts or lower return accounts. And here you don't have to. So everything has been invested. Maybe, okay, it's not high risk, but like moderate or maybe balanced. So you still get a high return compared to like a segment of your income portfolio being mapped to like cash returns. Okay, so that's why this is like a higher return, a better success rate. And depending on the investment horizon, okay, if it's shorter, if it's less than 20 years, so instead of 4% withdrawal rate, you can do 5%, let's say, and then 4, okay? And if you have longer horizon, so you have to drop the withdrawal rate by another 0.5 point to 3.5%. And then where you're investing the money, obviously, okay, the longer period of time, you know, then you have to put more equity because you want higher return. And then if it's a shorter horizon, you can afford to put more money into lower risk. So more fixed income, less equity, so low risk, okay? So, but this is all flexible, okay? I would say depending on the market's been like doing extremely well, so maybe you want to be a bit more conservative, or we have like a huge like bad market for 4 or 5 years, so maybe you can be more aggressive. So I would say, you know, take it with a grain of salt. And this is the highlight, and a lot of people asking. So I want to tell you, based upon the research, what I have to share with you. So I went on Morningstar and do a little bit of research, and I select this. This is the yield, 1 year yield, 12-month yield. Okay, so that's the interest rate paid, and I select the 4-star Morningstar rating. So good funds and good ETFs. Downside capture 85%. So when the market drops, I don't want my investment to drop more than 100%. It'll be less than 100%. So it'll be dropping less than the market. That's what I want. And I want the average return to be at least 3%. Okay, not only that, I have another criteria. Sometimes, so let's say they pay 6%, but then you have a negative return. So I don't like that. I don't want you to pay out for my principal. So I want whatever it is, you know, the yield has to be lower than the return. So I'm not going to be depleting my principal. So those are the criteria that I have. And when I did the research, this is what I pulled up, okay? So you see that you have like a range of investment, a range of like yields, okay? This is 12-month yield, and this is year-to-date return, okay? And this is 3-year, and 5-year. My criteria is at least like a 3%. So most likely, you know, I say 3%, you're probably pretty safe. If you go to 5%, sometimes you're gonna get a negative return. It's just not that easy to give you a sustaining 5% return and always positive, okay? I mean 5% yield, not return. The return normally is like the market return plus the payout ratio, the payout percent. That's the total return. These numbers should be everything. Okay, so this is fantastic. Okay, so we want income and we want some downside protection. So these are some short-term notes from First Trust, and they close like every month that you can invest in these notes. So let's take a look at this 9-month note. 30% downside protection. So the market drops 30% or less than 30%, your principal is protected. So you're not going to have negative returns. And it's paying out, wow, 12% yield, 3% every quarter. But if it drops 40%, then sorry, your note is only worth 60%. So if it dropped 40%, you only get 60%. So a lot of time what happens is that, you know, we'll recommend the investor, okay, so if the note is like down 40%, what you do is just buy S&P, most likely so. If it's down so much, it's gonna bounce right back. So make sure that you stay invested, that's in other words. And then the 18-month note, 40% downside protection, 8.5, so about 2.15% per quarter. So that can help you for a lot of expenses. They do have an upside barrier. That means like 30%, you know, you're not gonna make more than 30%. So it's like, you know, almost like not gonna happen. So you're not gonna have a return over 30%. I'm not worried about that. So that's the short-term structure notes. Here are the medium ones. Okay, so it's a bit longer, 5-year, 30% downside protection, and then 140% of the cumulative return. Okay, whatever the return is, the cumulative return, and they choose like industrial and 2 indexes, the worst performer between these 2. Okay, so give you an example. If the cumulative return is 3%, then you get 140% of that 3%, so you get 4.2%. If the cumulative return over 5 years is 10%, then you get 14%. Now, but then there's like 30% downside protection. So if the market drop anything less than 30%, you're principal protected. And this is, it's very similar, but it's 150% cumulative return, okay? Same, 30% downside protection. So people who want to grow would do this. The other one is for income. I think this income it's fantastic. And then if I get 40% downside protection, I think I'm basically good. And I get 8% yield. Wow. Now the only thing that you can minimum purchase is only $5,000. You cannot have more than 50% of your portfolio in these notes. And it's kind of a pain because 9 months, and you have to buy it again. You have to renew and buy it again, and again. So you have to do some work. But with that income, I mean, it's nice. And then the annuity. So like, let's say you need some more cash flow to fund for your expenses. Payouts too, this is pretty complex. It's at some downside protection, 10, 20, 30%, depends on what you pick. It has some upside limit too. These are pretty good. I don't even hit that, so basically don't worry. So what you pick, okay, and then so it's gonna grow at whatever rate, and then you have some downside protection, upside, so it's probably right kind of in the middle, instead of down like that, you'd be like this, like that, okay? And then here are the income distribution for life. I think that's pretty good, 4%. So there you go. So you have another option, you know, doing the annuity. But the annuity is like, once you cash out or once you annuitize, you cannot get the principal back. So you want it to grow, and at one point, then, you know, you distribute. And this is the last slide. I'm not going to talk too much about it because they're not doing too well. REITs, it's basically real estate income trust. They normally pay 5%. But because real estate right now, investments not doing very well, most of them are negative. So I'm not going to expand on it. And LPs is basically the all investment, also not doing very, very well. They are very volatile and illiquid. So I don't think it's like applicable to what we're doing for retirement income planning. So I like to talk about it because this is an important source for cash flow, but I don't think it applies for retirement income. And that's it. You know, any question? We almost like hit our 1 hour point. So that's all I have to share today. And you're welcome to click here, and then you can schedule something so you can review everything at your leisure. Okay? Any questions? Well, thank you for attending. You are welcome anytime to email me. And if you have any interesting topics that you want me to cover, let me know, because I will be doing these webinars on a continuous basis. Thank you very much. Thank you for attending. Bye-bye.